Oxford Biomedica plc are a gene and cell therapy company in the FTSE Small Cap Index. Today, we're going to crunch their numbers and see how they fare on our leaderboard. Hey there guys, welcome to the FTSE Show with me, Chris Chillingworth, the show where we break down FTSE stocks to identify long-term investments, the companies that are ideally suited towards share price growth over the next, say, 2 to 5 years, and those that are not. And we've found many so far that are not, and some pretty good ones as well. So we're slowly building up this leaderboard, slowly adding more and more companies to this list, and starting to identify why some companies are good, why some companies we should be avoiding. Today we're going to take a look at Oxford Biomedica plc, Biomedica plc, I should say. These are a company in the FTSE Small Cap Index. They specialise in treatment for cancer, in gene and cell therapy. That's pretty much all I know about these guys. Let's dive into the numbers and see how we get on. Okay, so let's check out these numbers then with Oxford Biomedica. Epic code is OXB. They're in the FTSE Small Cap Index and they come under the pharmaceuticals and biotech sector. So, first of all, there's been some obvious revenue growth here. We can see that back in 2009, which is the earliest year that we have available because of when they floated on the markets, they were on 19.1 million, then out to 66.7 million. It hasn't been a cut and dry straight trend upwards. Really, there was a downtrend between 2009 and 2013, which we then saw some sort of a pivot where since 2013 we've had probably six years of consistent growth there, and quite significant growth as well, to go from 5 million a year revenue to 66.7 million a year revenue. So definite revenue growth in the last 6 years, so that's good. That's a good sign. That means that they're obviously able to bring more money in each year, and quite considerable growth there, which I'm quite impressed with. Cost of sales has clearly grown with that. So then what we want to do is we want to work out, well, what's the percentage of that slice essentially. So the gross margin that they were taking back was in 2013 was 78.8. That's gone down to 65.9. So the cost of sales has grown at a faster rate than the revenue growth, but not to a point where you'd be dramatically concerned with that. So that's, not too bad. We can look at expenses. Expenses are at a level that I would consider fine, based on the revenue coming in and the gross profit that the company have. If they're bringing in 44 million and they're needing to spend 7.4 million on expenses to run the business, which essentially works out about 17%, that's pretty good. And we've seen, I would say there's a downtrend there in terms of the actual money that's needed to be spent on expenses. So as you can see, the raw numbers here have gone up with expenses. But the percentages have gone down because obviously the revenue's gone up so much more, the gross profit has therefore gone up so much more, yet the cost of the expenses, the running of the business, the rents, the staff costs, they haven't dramatically grown in accordance with that, which is good. Essentially, expenses have stayed at around the same figure over the last kind of 4 years, you could argue, despite the fact that revenue has jumped from 15 to 66 million. So that's a good sign. However, here is where things become a little bit unstuck with Oxford Biomedica, and this is very typical of pharmaceutical and biotech companies. The R&D costs, the research and development costs, are very high. If we're looking at 2015 as an example, these guys had a 10 million gross profit. 6.7 million from that came and was spent on expenses to run the business, but 20.2 million was the cost for research and development, which brought them down to pretty much minus 17 million operating profit. And this is really the story of this company. The research and development costs are very high, and they've eaten up all the profits, essentially. And this has been the story every single year since 2009. You look at this operating profit trend, we've got minus amounts every single year until 2018. So essentially what's caused these minus years has been the research and development costs, and we can tell that from the percentages of the gross profit, 169% 250%, 325% of the operating profit being spent on research and development. Obviously, way more than money than the company actually had coming in from the revenue that they generated. And so, but in the last year, because of the dramatic growth in revenue, I mean, they've pretty much doubled, you could argue, from 2017 to 2018. Cost of sales, however, has only gone up slightly. Certainly nowhere near the same kind of level of incrementation. Their gross margin has jumped 15%, so the slice of the pie has grown by 15% that they get to keep. Expenses have stayed around the same, and research and development went up, but not by a dramatic amount. We're talking 8 million difference there. So this is why the percentage has gone down, because more money's coming into the business, but research and development has stayed around the same. It hasn't grown to anywhere near the same rate. And so for the first time, they've had a profit, an operating profit of 6.8 million. Interest on debt, however, is quite high. 8.9 million last year spent on just the interest on debt alone. So unfortunately for Oxford Biomedica, that alone would knock them down into, again, a losing year. However, they had extraneous circumstances, had extraneous income coming in, which brought in some income for the business. And so for true accounting purposes, they recorded a £7.5 million profit. However, if we remove the extraneous income, i.e. the income that's got nothing to do with the day-to-day running of the business, they actually only made about £494,000 profit nonetheless, but a margin of or a net earnings of 0.7%, which is, I mean, it doesn't go anywhere near covering what they've been losing every year, millions. If we take the last, how many years is this? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 years of analysis, and we take the net earnings every single year, the total sum of money won or made or lost, I should say, is minus 104 million. So these guys have got a lot of work to do to catch up and to get the business back to making a profit for its shareholders. Average end result is about minus 10 million a year. So this is costing shareholders 10 million a year to be an investor, which is not cool. So obviously we're not looking good at the moment. Let's go down into the balance sheet and we can look at the assets and liabilities. So total current assets, they have been growing. Again, we've seen a similar story here where the assets fell in value. They went from 32.2 million in value down to 6.9 million in value. So that was a lot of value lost there in terms of the assets owned by the business. That's obviously turned itself around in the last 6 years. They've definitely made some strong developments there. 30 million of that, however, is net receivables. That's money owed to them by other people, which counts as an asset because you're eventually going to recoup that money. It's just not in the bank right now, so it gets recorded as an asset. Other people owe them this money, and hopefully they'll be able to get that money off people later down the line. But that is a large proportion of where those assets come from. In terms of current ratio, the short-term assets covering short-term liabilities, that's looking pretty healthy. They got 2.4 times the amount of short-term assets against liabilities, so they cover the liabilities absolutely fine. Not a problem at all. So we're definitely looking at the total assets here. We've got definite assets growth here from 43.9 down to 13 million in 2013 and now back up to 112 million in value of the total assets of the business. I want to take a quick look at debts. They've got no short-term debt at all, so that's okay. You know, nothing to worry about there. Long-term debts, however, they ran with no long-term debts for a long time until about 2015, and those long-term debts have started to creep up from 27.2 million to now, in the last report come out, 41.1 million. The problem we've got here is that this debt level is growing, and they've got no way of paying it off, because they're not making any profit, they're not making any money, and so they're going to struggle to pay off that debt. And as at current levels of earnings, i.e. £494,000, it would take them 83.3 years to pay off this £41.1 million debt. Now, obviously, it doesn't quite work out that way. This is just a way to measure, are they biting off more than they can chew? The answer there, based on this criteria, is absolutely. That debt level is too much based on what they can actually pay. So there's a concern there for sure. I want to take a look at retained earnings. Retained earnings, this is the pot of money that the company should be pumping money into every single year to use for, a rainy day fund, or it might be used for an acquisition of another business that they want to bring in, or it might be used for special dividends to attract more investors, whatever. It's money that isn't being directly spent on anything right now. They're put into one side. It's to be used in the best interest of the shareholders, the people who own the business, to grow that company, to do something good with it. Unfortunately, Oxford Biomedica have been running at a deficit on their retained earnings. Their pot is not only at zero, they owe money into the pot. And this has been getting worse pretty much year on year. Now, this is largely because they've not been making a profit. So how can they put money into this pot if they're not actually they don't have any money to do so? So this is a really bad sign. The fact that they are now 173.8 million in debt to their own reserves, essentially, is not a good sign. Big warning sign for me. And obviously, return on shareholder equity is going to be in the minus because they're not making a return. They're not making any money on the assets that they own. So if you think of all the assets that this company owns, a total value of £112.4 million worth of assets, those assets are not producing any profit for this company. And so the return on shareholder equity is always in the minus until the last year at 1.4%, which is unfortunately relatively woeful. Just having a quick look at the chart then, and we can see here this is not a company we'd want to be investing in. Looking back in 2008, they were trading as high as nearly £21 a share, and we've come crashing down between 2008 2009. The numbers did not look good in that particular period of time, and they haven't got any better until the last year when they finally made a profit. But the share price fell all the way down to about £4 a share, and it's been bouncing between £8 and £1 a share over the last, let's say, 10 years, and really just not going anywhere. In the last, let's argue, 2 years, there's been a bit of growth in share price, perhaps, but we're still only at £6 a share, and we have seen higher than that in previous years. So it's not looking great. If you had been an investor back in 2008, you would not be happy with where this has gone. Now, one thing I really want to make clear in this particular episode today is that, yes, some of these companies do actually move in terms of the share price, and you could invest in these companies and do all right. Here's my problem. There are better companies out there that give you a better chance of achieving that. Oxford Biomedica have too many question marks, too many dark kind of shadows cast over those numbers. There are too many concerns there that would reflect the fact that the share price probably won't go anywhere over the next 2 to 5 years unless the numbers dramatically start to improve. And we've seen, historically speaking, looking back, the poor numbers we've been looking at correlate directly with very poor share price growth. And this is the pattern that I've always seen. And I see this constantly across all the FTSE stocks. Companies that are ticking the boxes of what I'm looking for have much better charts than this, and we'll see those. We've seen some of them with previous, like Bodycoat and Intertech. We saw those. The charts looked way better than what we're looking at right here with Oxford Biomedica. And there are better companies out there. When you've got a certain amount of capital that you need to put to work on the stock market, and you've got thousands of stocks in front of you, and you don't know which ones to pick, this is the process of identifying that this company is probably not one of the companies you want to be putting your money into, because there are other companies out there that will give you a much better probability of share price growth. Oxford Biomedica are not that company. And so for that reason, I'm not an investor. I'm not interested in this particular stock. The numbers do not correlate with share price growth, and the odds are against them to see this grow to the £30-40 a share that we want to see. So with that, let's go over to the leaderboard and see how the company fare over there. Okay, so high R&D costs, main issue here. They got some decent revenue numbers coming in. There's obviously revenue growth there, but this is a company that are looking at cancer treatments, and unless they find a cancer treatment throughout all this research where they suddenly bring in a ton of revenue and no additional costs or expenses, then it's a risk. And for me, there are better companies out there to invest my money into for share price growth, rather than needing to take a risk on a company like this that may not find the treatments that they're looking to try and research. So it's very similar to mining companies when they're trying to mine for certain ores and stuff, and they don't know if they're going to find it or not. And if they find it, there's going to be big payouts, big profits. If they don't, shareholders lose out. I don't want to play that game. There are companies out there that I know are churning through the numbers every single year, and they're ticking all the boxes every single year, and those are the companies I'm more interested in, rather than trying to take a punt with a pharmaceutical biotech company like this. And the numbers just don't score well. So let's take a look and see how OXB actually did then. Now, I did promise that we would be adding a company to this leaderboard that would score some decent points. Next week, we do have a company that are going to do that for us, and tune in for that, because we've got a company as well that I think might top the leaderboard. OXB, however, the numbers are just not good enough, and unfortunately they score a very poor, but not the poorest, minus 39 points. So we've got another minus company to go onto the leaderboard. Let's add them on. So there we go, 6th place for OXB, better than AA, BP, Tesco from a long-term, sort of 2 to 5 year, maybe longer investment period. Just not one of the stocks that we really should be looking at investing in. I'm certainly not interested. There are far better companies out there that we're going to see in future episodes. Companies like Bodycote, you know, they top the leaderboard. Intertech, you'll get much better results out of those companies, I suspect. You've certainly got a much greater chance of getting better results out of those two companies than you have from companies like Royal Mail, Oxford Medical, all of these companies that are just not suited. They are not geared particularly well for strong share price growth over the next 2 to 5 years. There's too much in there that could hamper that share price growth, when there are other companies out there that are not showing any of those signs. Much better companies to be putting our money into. So that's where they end up. And tune in next week, and I promise we will have a company that are much higher up on the leaderboard. Cheers, guys. Before you go, if you have enjoyed the FTSE Show, if you're enjoying the series at all, please give this video a like. That would be awesome. Cheers, guys.